Welcome to Alamut Capital Knowledge Center. When most people think about investing, they think about one powerful idea: compounding. Invest consistently, earn reasonable returns, give it time, and over decades, wealth grows. That principle is absolutely true. However, yet we oftentimes see individuals and even experienced investors not able to fully realize the compounding effect. More often than not, we have seen individuals who invest in low-cost S&P 500 ETF end up making lower returns than the publicized long-term average return of 10%. Because people often interrupt compounding process several times in the long-term time horizon by panic selling, unplanned liquidity needs, emotionally driven decision, etc. And the root cause of such interruptions is risk. And this is the other side to compounding that receives far less attention: risk. And risk compounds too. At Alamut Capital, we believe long-term wealth isn't built only by capturing returns. It's built by preventing risk from quietly multiplying beneath the surface of a portfolio. Compounding is neutral. It multiplies whatever dominates your portfolio structure. If the portfolio is resilient, returns compound. If hidden fragilities build, risk compounds. The challenge is that fragility rarely appears during calm markets. It usually becomes visible only during stress, and history has shown this repeatedly. During the late 1990s, many investors believed they were diversified simply because they owned broad market exposure such as the Nasdaq Composite, or modern tech-heavy exposure like QQQ. On paper, investors owned hundreds of companies, but the risk was concentrated in growth stocks, technology sector, and extreme valuations. When the environment changed, the Nasdaq fell nearly 78%. Even diversified exposure like the S&P 500 ETF declined more than 50%. The real issue wasn't lack of holdings, it was concentrated factor exposure that had quietly compounded. Before 2008, a textbook diversified portfolio often included U.S. equities through the S&P 500 ETF, international exposure through the Vanguard Total International Stock ETF, and bonds through the iShares Core U.S. Aggregate Bond ETF. Many investors even package these exposures inside balanced portfolios, like the iShares Core Growth Allocation ETF. It looked diversified across geographies and asset classes. But during the crisis, correlations spiked, credit risk surfaced everywhere, and volatility persisted. Balanced portfolios declined sharply because systemic risk had been quietly building across assets. Going into 2020, traditional balanced portfolios appeared stable. But in March 2020, volatility exploded, liquidity temporarily disappeared, and markets fell rapidly. Even globally diversified exposure like the Vanguard Total World Stock ETF dropped sharply in weeks. The key lesson: risk regimes can shift much faster than static portfolios can adapt. For decades, investors relied on the idea that stocks and bonds moved differently. A classic allocation split between equities and bonds was considered structurally diversified. But in 2022, inflation surged. Interest rates rose rapidly, and stocks and bonds declined together. The structural assumption behind diversification had changed. Portfolios were balanced by percentage, but not by regime resilience. Across every crisis, one pattern repeats. Portfolios appeared diversified, allocations looked balanced, strategies followed conventional wisdom. Yet risk had been compounding beneath the surface through concentration drift, factor dominance, correlation shifts, and macro regime transitions. And it only became visible during stress. Most portfolios are rebalanced on a schedule, quarterly, semi-annually, annually. Assets are simply returned to fixed targets. But calendar rebalancing is often cosmetic. It restores percentages, not necessarily risk balance. If volatility has structurally increased, if correlations have shifted, if economic regimes have changed, returning to the same weights can actually reinforce hidden fragility. At Alamut Capital, we believe portfolio management must evolve with market conditions. Instead of relying purely on calendar schedules, we focus on regime-aware rebalancing. We evaluate volatility, expansion or contraction, correlation relationships between assets, factor leadership and broad macro regime. The goal isn't constant trading, it's aligning portfolio risk adjusted with current environment and clients' actual risk profile. Over long investment horizons, wealth is shaped less by average annual return and more by depth of losses and stability of compounding. Compounding is one of the most powerful forces in investing. But it works both ways. It compounds returns, and it compounds risks. At Alamut Capital, our fiduciary responsibility is not only to grow your capital, but also manage risk at the same time, which enables you to continue the compounding process without interruptions. And this can only be achieved if your portfolio aligns with your risk level at all time, and not reflect current environment risks. Reach out to Alamut Capital to learn how we can help you finally achieve the elusive compounding benefits.